0, 1, 1, 2, 3, 5, 8, 13, the Fibonacci sequence, each number is the sum of the two before it. Simple rule, wild consequences. Named after Leonardo of Pisa, Fibonacci. He popularized it in 1202 with a rabbit problem in Liber Abaci, but he didn't invent it. Centuries earlier in India, scholars mapped patterns in poetry that matched these numbers. So the idea traveled, born in India, reborn in Italy, and now everywhere. Why does it keep showing up? Because hidden in those numbers is a ratio. Take any Fibonacci number and divide it by the next one. You approach about 1.618. That's the golden ratio, phi. Flip it, you get about 0.618. Nature seems to like this ratio. Spiral shells, sunflower seed patterns, pine cones, hurricanes, galaxies, arrangements that maximize efficiency, pack tightly, distribute evenly. It's not magic, it's optimization. And humans? We're pattern machines. Which brings me to day trading. Traders use Fibonacci because markets are crowds, and crowds have habits. After a big move, price often snaps back or retraces before deciding what's next. Fibonacci tools try to mark where that snapback might pause. The first tool is Fibonacci Retracement. Take the low and the high of a strong move and draw a grid. 38.2%, 50%, 61.8%. Technically, 50% isn't Fibonacci, but psychologically it matters. 61.8% is the golden ratio's inverse. In an uptrend, I watch price pull down toward those lines. If buyers step in near 61.8%, that's a hidden support zone. In a downtrend, the same levels flip into potential resistance. Second tool, Fibonacci extensions. Once a trend resumes, where might it go? 138.2%, 161.8%, 261.8%. Those become objective profit targets, places to scale out before momentum fizzles. Now, the big question, do these levels work because the universe runs on Fibonacci, or because traders do? Here's the honest bit, a lot of it is self-fulfilling. Orders cluster at 38.2%, especially at 61.8%. Liquidity piles up there. Reactions happen there. It doesn't make Fibonacci mystical, it makes it measurable, but measurable is not guaranteed. Trend strength, macro news confluence, when multiple signals overlap. A naked Fibonacci level without confirmation? That's not strategy, that's a wish. So here's the fast checklist I use. Identify a clear swing high and swing low. No cherry picking. Plot your levels. Wait for confirmation. A bounce candle. A volume kick. A momentum shift. Plan exits with extensions, and define risk first. If price slices clean through a level, I'm out. Zooming out, the coolest part isn't the trade. It's the bridge. A pattern spotted in ancient poetry ends up plotting modern markets. One simple rule, add the last two, unfolds into spirals, and gives us a telescope to see structure where noise used to be. Respect the math.